Very good morning to all of you students. Today we will be continuing on the topic of mergers and acquisitions, where we had left on one question, which is question number 20. Then we will cover some of the conceptual aspects or theoretical aspects of mergers and acquisitions. And then we will take up the startup finance. So that is going to be the agenda for today's session. So let's start, students, from question number 20, which is a very, very good question, right? Shailesh, Mohammad Abdul, Viraj, Kumari Jyoti, Shruti. Good morning, everyone. Question number 20, students. During the audit of the weak bank, RBI has suggested that the bank should either merge with another bank or may close down soon. Strong Bank has submitted a proposal of merger of weak bank with itself. Now, there are two banks that they're talking about. One is the weak bank, which is planning to get merged with the strong bank, and strong bank has submitted a proposal around it. The relevant information and balance sheet of both the companies are as under. So they have given us the gross NPA percentage. What are NPA? NPAs are non-performing assets, right? For a bank. So students, you would recall in the first session of M&A, we have discussed about the swap ratio once it comes to NPA, right? And NPA being a negative ratio, for example, higher the NPA, worse it is for the bank, right? Because NPA should be lower. So we said that for NPA, we will use the reverse for swap ratio, right? Like we were using for market price, earnings per share. We will not use the same way. We will take a reversal of that. We will just see in this question. Okay. Good morning, Mincha. So if you see, weak bank has a 40% NPA ratio and strong bank has only 5% NPA ratio. So that means strong bank has a lower NPA in its portfolio, which is a good signal, right? However, whatever loans weak bank has given, out of that 40% are non-performing assets. By non-performing assets, I am hoping that all of you would know what do we mean in the banking terminology. So these are the assets or these are the loans that bank has given on which bank is either not getting the principals or it is also not getting the interest. So there are no service happening back of interest or principal. And these are overdue for more than certain days. NPA is understood. Then second ratio is capital adequacy ratio. So students, capital adequacy ratio is another ratio which is actually a positive ratio. Higher it is, better it is. Lower it is, worse it is. So capital adequacy ratio denotes that how much adequate capital you are holding, right? So below that, they have given us the formula as well. Total capital divided by the risk weight assets. So by risk weight assets, we mean that there are different assets which will have different book value. Now those different book values will be multiplied with their respective risks, right? To arrive at the risk weight assets. Okay. And hence total capital. Okay, students. So the total capital divided by risk weight assets will give us the capital adequacy ratio. Okay. Because it will denote two things. Higher ratio of CAR will denote two things. One, the risk weighted assets is lower and the capital is higher, which is a good signal for a bank. So similarly, if you see, strong bank has a 16 as CAR and weak bank has only 5, which is again a signal of weakness that the bank is undergoing. Then next one is market price per share 12 and 96. Okay. Book value, they have not given us, but they have mentioned the assigned weights. Now they have given us the different weights. How do they analyze the both the informations, right? NPA, they take a certain 30% weightage. CAR, they say that it is 28% relevant for us. 32% relevant is the market price and 10% relevant is the book value. Trading on stock exchange, they have said that the weak bank, it is irregular, it never happens. And strong bank, it is frequent. That means it keeps on happening. Now coming to the balance sheet, students. Weak bank and strong bank, starting with the paid up share capital, reserves and surplus and deposits, and further other liabilities. So the total liabilities are this much, 5120 and 52,500 for weak and strong bank respectively. Cash in hand and with RBI is this much, 400, 2,500. Balance with other banks is 22,000 that only strong bank has. Weak bank is not having any balance with other banks. Investments, they have given advances, they have given other assets and preliminary expenses. These all things they have given to us. Calculate the swap ratio based on the above weights. First part is very, very simple, students. They're asking us to calculate the swap ratio basis these weights. Okay. Can we do that? Yes. Calculation of swap ratio. Okay. So let's start point by point. So the first one is basis gross NPA. Now, students, you tell me 40 is the target company's ratio. 5 is the acquiring company's ratio. In the normal parlance, we would have done this, right? So the ratio is coming out to be 8 is to 1. So what does this mean? That 8 shares of strong bank to be issued for 1 share of weak bank. 8 shares of strong bank to be issued for 1 share of weak bank. Don't you think there is something wrong here? It cannot be this way. Why I am paying more for a company which has a higher NPA, right? So the correct way to do the swap ratio basis gross NPA is 5 by 40 students. Getting my point? So let me just write it. NPA percentage of acquiring company divided by NPA percentage of target company. Yes, Mansha, should be 5 by 40. Now, this even we can check from the initial swap ratios. See, A Limited was the acquiring company and B Limited was the target company. Okay. I think there was one question also during that session. I don't remember the name of the student who was asking. So I hope this answers that. Okay. So the logic is that higher NPA, lower the ratio should be. Hence, we reverse the ratio in this particular case. Okay. So this comes out to how much? 5 divided by 40. Then B part is basis the capital adequacy ratio. Now this will be CAR of target company divided by CAR of acquiring company. Okay. So which is 5 by 16. Correct. So this makes sense. CAR of target company numerator, if it is 5, so that means we will have to issue lower number of shares because the CAR is lower. Correct. Market price per share. So the ratio is given by MPS of target company divided by MPS of acquiring company. Correct. This is the formula. So MPS is how much? 96 and 12. 96 for the strong bank and 12 for the weak bank. So lower MPS means lower shares to be issued, right? So 12 by 96. Then D part, book value per share. So book value per share of target company divided by book value per share of acquiring company, students. Now, do we have the book value? As of now, I think in the question it is not given us to straight away. So let us try to find out the book value per share. Calculation of book value per share. So we will start with the weak bank and then we will go to the strong bank, right? So can anybody tell me how should I take the book value per share, students? What should be, what are the elements from this balance sheet that I should take to arrive at the book value per share? Let's start with the strong bank first, okay? So strong bank, what is the book value, or weak bank, what is the book value? Tell me. What all components should I take to arrive at the book value, students? The balance sheet is in front of you. Tell me, students, what should be the book value? We have paid up share capital, we have reserves. Okay, so Abdul is saying Total assets less deposits and other liabilities. Total assets is, let's say, 5120 of weak bank, less deposits and other liabilities, which is 4,890. Similarly, for strong bank also, same thing. Okay. No, Shruti, yes, we have to take balance sheet items, but which balance sheet item should I take? Or let me know what is the book value according to you for both weak bank and strong bank. Gurram is saying strong bank is strong in every perspective. Yes, Gurram, that's why it is a strong bank. See the balance sheet of the strong bank. They have a reserves and surplus of 5,500, right? Even they have advances of 27,000. Investments is around 19,000, right? So they have a big book value, right? Okay, Suraj is saying that paid up share capital and reserves and surplus. Mansha, assets minus other liabilities. Okay, Mansha is including deposits. Satish Kumar, good morning. Viraj, paid up share capital reserve 230 and 6,000. 230 is 150 plus 80 and 6,000. Okay. Is it all right? Or see, at least I can tell you, we have one important thing which is there in front of us, which no one is talking about. While computing the book value, there is very much an important thing which is right in front in this balance sheet. Yes, Viraj has highlighted. Very good. But Viraj is asking me, Viraj is not telling. Yes. So it is preliminary expenses, students. So what happens? Preliminary expenses are deemed to be a debit balance in the reserves and surplus, right? Because there is nothing called as preliminary expenses that is allowed to be carried forward in balance sheet, right? It's just that whatever they have given to us, we have to just reduce it from the paid up share capital and reserves and surplus to arrive at the book value, students. Okay. So, Shruti, BV weights. BV weights, what do you mean by BV weights? Book value weights. I'm not able to understand, Shruti. Okay, so weak bank and strong bank. What is their paid up share capital? Paid up share capital is 150 and 500. Add reserves and surplus. Reserves and surplus 80 and 5,500. Then minus preliminary expenses. So the weak bank has even treated the preliminary expenses in the wrong accounting manner. Okay. So they should have not done that. So finally, we are reducing it from their net book value. Okay. Yes, Suraj, it's not included in reserves and surplus. That's why we are including it by reducing it, right? So ultimately, if today I want to ask you that what is your book value, what you will say to me that, okay, I will realize 400 in cash. I have investments of 1,100. I will realize that advances I have given 3,500. I will take that back. Other assets also, I will consume it or whatever is the realization I will do at a 70. But who will pay you back this 50 rupees? No one, right? These are the expenses that has already been incurred. In the previous, let's say, very old accounting gap, we used to do the preliminary amortization. Now in India's and even post Companies Act 2013, this was disallowed, even in the regular accounting standards, right? So now this 50, whatever they have put here, is not correct. has to be charged off to these reserves and surplus while we are valuing it. Okay. Okay, Shruti, now I got your point. Yes, this weight we will assign later on. Okay. 10% weights will assign later on to the book value. Okay, so this comes out to 150 plus 80, 230 minus 50, 180. This is 6,000. Number of shares. We had how many number of shares for 10 rupees? 150 is the capital and 500 is the capital. So this we can arrive at 150 divided by 10. So which is the share capital divided by the face value. Okay. Similarly, here also 5,000, sorry, 500 divided by 10. This is 15 and this is 50. Okay. So if we divide the total book value, this is the total. So the total book value, if we divide it by the number of shares, we get how much? 180 divided by 15. So we get book value per share. So this is 180 divided by 15 and 6,000 divided by 50. Okay, so the book value is 12 here and 120 here. Hence, okay, so this is understood, students, till now. Suraj, okay, so sir, we were writing it off like we do in P&L account. Yes, Suraj, we are writing it off. Okay, now the book value of target company comes out to 12 rupees and the book value of strong bank is 120. So strong bank is 10 times stronger than the weak bank. Okay. So this is 1 is to 10. Now, once we have individually calculated these ratios, let us calculate the overall swap ratio. Calculation of overall swap ratio using assigned weights. So let's pull the ratio here. Weights and weighted ratios. So first one is basis the gross NPA. What was the ratio, students? 5 is to 40, right? Only this was the reverse ratio. Rest all are the regular ratios. Okay. Weight was how much? 30%. Second, we have capital adequacy ratio 5:16. This had a weight of 28%. Then third one was market price per share. Market price per share is 12:96. This had a 32 percentage weight. Book value per share 12:120. This had a 10% weight. Okay. Now, students, if you have to solve this, then simply what we can do is first take the ratio and division. Let's say 5 divided by 40 in the calculator, then multiply by 0.3 to arrive at the weighted ratio. So the weighted ratio in the first case becomes 0.0375. Second case, 5 divided by 16, you do in the calculator, then multiply it by 0.28, which is 28%, right? So this becomes 0.0875. Then third case, 12 divided by 96 into 0.32, this becomes 0.04 students. Then finally, 12 divided by 120 into 0.1. So 0.01. Let's take a total of this here because the weights we have already multiplied. So we'll just take a simple total. 0.1750 is to 1. So for every 1 share, the strong bank will issue 0.1750 shares to the weak bank. Good morning, Anush. Okay, Satish. Very good. So we have solved for the first part of the question. Okay. Now the second part. Ascertain the number of shares to be issued to weak bank. Can we ascertain the number of shares to be issued to weak bank? We already know what is the swap ratio, students. Swap ratio is 0.1750. So simply we will multiply with the total number of shares that the weak bank has already issued to its shareholders with this swap ratio to arrive at the total number of shares to be issued. Let's go to the second subpart. Number of shares to be issued by strong bank to the shareholders of weak bank. Okay. In this case, 150 divided by 10. That means 15 were the number of shares, right? For weak bank. This we will multiply with the swap ratio. 2.625 lakhs shares. Simple, right? So from 15 lakhs shares issued by weak bank, we will be issuing 2.625 lakhs shares. Okay, students. Now the third part. Prepare the balance sheet after merger. So they are asking us to prepare the balance sheet after merger. So what will happen, students, while preparing the balance sheet? Let's say this is the balance sheet of strong bank, right? And this is the balance sheet of weak bank. Now, what will happen, students? They will issue, strong bank will issue this much of share that we have already understood, right? And the book value of the net assets that we will take over is 180, right? 180 is the value that we will take over. So what will happen? The assets, the assets and the liabilities will get added to the extent of 180, right? And the strong limited will issue shares to some extent, which is 2.625 lakhs. These are the shares that will be issued. So the difference between these two goes to the goodwill or capital reserve, right? If it is a debit balance, or let's say if I have paid higher amount, it goes to goodwill. If I have paid lower amount and taken over higher assets, then it goes to a capital reserve, students, right? So let's do it like this. Book value of weak bank, 180, right? This is we have calculated, minus issue of shares 2.625 lakhs multiplied by 10 rupees is the price, right? At 10 rupees, it will issue 26.25. So the difference is 153.75, which is the capital reserve, students. Correct? Because we have got 180. Let's say we have gone to purchase a company. While purchasing a company, we will get 180 worth of assets minus liabilities. And what we are paying is only 26.25 worth of shares. So ultimately, we will get a benefit of 153.75. So let's prepare the balance sheet as on whatever is the date. Rupees in lakhs, is it? Yes, rupees is in lakhs. So students, if you see in the question, they have started with the paid up share capital and then reserve and surplus, deposits, other liabilities, cash in hand, and this thing. Okay, so we will start in the same order. Strong bank. So first of all, students, okay. Hmm. Paid up share capital. $500 was the base, right? Was the amount that was already issued. How much have we issued now? 26.25. So 500 plus 26.25. So this becomes 526.25. Reserves and surplus. It is not going to change, right? While we are adding the business or while we are taking over the business, the reserves and surplus of the previous company will remain as is, subject to the goodwill or capital reserve that gets freely generated, right? In this case, there is a capital reserve. How much is the capital reserve? 153.75. Then rest all items, we just have to do the simple line by line consolidation, right? So for example, deposits. So these are the deposits appearing in the liability, right? If we go and check the existing balance sheet, the deposits are 4,000 plus 44,000. So in totality, 48,000. We will ignore now this, right? We will not adjust this as well as the preliminary expenses. Okay, because 150, 80, and 50, we will not be adjusting it separately. So how much it comes? 4,000 plus 4,400, 48,000. Then comes other liabilities. Other liabilities also we have to do just simple horizontal addition, line by line total. That's all. So other liabilities is 890 and 2,500. 2,500 plus 890, 3,390. So the total of equities and liabilities is how much? 526.25 plus 5,500 plus 153.75 plus 48,000 plus 3,390. 57,570. This is the equities and liabilities. Now let's come to the asset side. Okay. So in assets, we have cash in hand, I think, or with RBI. This is a one line item. Cash in hand and with RBI is 400 plus 2,500. So 2,900 is this amount. Okay, so let me do it like this. So 400 plus 2,500. This is 2,900. Then balance with other banks. This is how much? 0 plus 2,000. So in totality, 2,000. Investments. Investments are 1,100 and 19,000. Okay. 20,100. Then advances. 3,500. plus 27,000. 30,500. Then we have other assets. How much is the value? 70 and 2,000. So 2070. The total, if we put, is 2070 plus 30,500 plus 20,100, 2,000 plus 2,900. 57,570 total assets. We don't have to take any preliminary expenses here. Why? Because this is already adjusted in the net book value taken over. Okay. Mohammed Abdul Rahim has asked a very good question, and I really appreciate that. And some of you also might be thinking that while I've calculated the capital reserve here, I have taken the issue price as the book price, as the face price, face value, not the current market value, right? So if you see the current market value is 96. Had I issued these much shares at 96, then my goodwill or capital reserve calculation would have been very much different. So in this case, it would have been 2.625 into 96 was the price, right? 2.625 into 96. So 252. And in this case, the goodwill would have come. So 252 minus 180. 72 of goodwill would have come. So you can do that way as well, Mohammed. Okay. Since this is not a paper one class, FR class, because in your financial reporting, as per NDS, you would have done this treatment only, correct? So this treatment is also equally acceptable, whether you issue at a book value or let's say the face value or at the market price, both the treatments are okay. Understood? But I was expecting this question. Good, Mohammed, you asked this. Okay. The balance sheet is getting tallied. So the balance sheet is done. So the third part of the requirement is also done. Although it's a very extensive or a big question, but this is very, very important question because there are some different catches in this, right? Which all of us have to be really careful students. Then last part, calculate CAR and gross NPA of the strong bank after merger. They're asking us to calculate the CAR and gross NPA. Calculation of CAR after merger. Okay. So after merger, how would CAR would look like? Okay. So this is capital adequacy ratio. Okay. The formula is also given in the question. Total capital divided by risk weighted assets, right? So the capital adequacy ratio is the total capital divided by the risk-weighted assets. So weak, strong, and then merged. Okay. So this is 5%, 16%. Merge we will compute, right? What is the total capital, students, before merger? Because when we talk about weak and strong, 5% and 6%, we will talk about before merger values. So if you see 5% and 16%, right? These are all before merger values. So the total capital was 180 as we have calculated as per the book value and 6,000, right? So if you see, we have this in the equation, we have this. Can we find out the risk weighted assets? Yes. Risk weight assets. Let me just put the equals to here so that all of you read it as an equation. Okay. So risk weight assets is 180 divided by 5%. Similarly, 6,000 divided by 16%. Okay. So this becomes how much? 180 divided by 5%. So this is actually 3,600. And this is how much? 6,000 divided by 16%. So this is 37,500. Or else let me put it above or below. So this was how much? 3,600. And this was how much? 37,500. Okay. So the total will become 3,600 plus 37,500 for risk weight assets. So risk weight assets, we will just do a line by line addition, just we like did for the regular balance sheets, right? So this becomes 41,100. Okay. Now the CAR, let us write the complete full form. Capital adequacy ratio for combined entity becomes, we have just now prepared the balance sheet, students. Can we see what is the total capital? We will take the share capital, we will take the reserves, and we will also take the capital reserve. Okay, so 5,500 plus 526.25 plus 153.75. So 6,180. 526.25 plus 5,500 plus 153.75. Okay. So this divided by 41,100 for the overall risk weight assets, right? This will be just a single total. So this becomes 15.04 percentage. So the capital adequacy ratio for combined entity becomes 15.04 percentage. Okay, clear? I think the last requirement of the question left is to calculate the gross NPA at the combined entity or the combined bank level, students. So D again, but subpart 2, and I can mention this as D as subpart 1. Okay. So calculation of gross NPA percentage after merger. Again, we have weak bank, we have strong bank. These are both the banks before merger, and then finally the merged bank, right? After merger. So gross non-performing assets as a percentage were 40% in weak bank and 5% in strong bank. Merged, we have to calculate. Okay. Now tell me, students, I'm asking all of you a very basic question. This is the balance sheet. As per the question, this is the balance sheet, right? Now, this NPA is on which financial statement item in this balance sheet? Can anyone tell me? This NPA percentage of 5% or 40% is calculated on which of the financial statement item in the balance sheet of a bank? Come on, students, tell me. This is very easy. Okay, tell me in which, what is the line item in the balance sheet that gets impacted or on which the NPA is calculated, students? Is it cash? Is it balance with other banks? Is it investments? Is it advances? Is it other assets or is it preliminary expenses? Or is it deposits or other liabilities that is mentioned in the liability side? Very good. I am getting some very good answers. Very good. Satish, Gurram Venkat, Suraj, Mohammad Abdul Rahim, all of you are correct. Absolutely correct. This comes on advances. So the advances are how much? Let us see, 3,500 and 27,000. Okay. 3,500, 27,000. These are advances. So advances multiplied by 0.40 will give us the non-performing assets value, right? Sorry. Gross non-performing asset, this is in percentage, this is in absolute. So this will become 3,500 into 0.40. So this is 1,400. Then this will be 27,000 into 0.05. 1,350. Okay, so 1,350 plus 1,400 is equal to 2,750. Right? Is just a horizontal summation to arrive at the total NPA, right? And the total advances is also a horizontal summation, 30,500 students. So the gross NPA becomes 2,750 divided by 30,500 into 100. Yes, I have got other answers also. Mansha, Shailesh, Kumari Jyoti, Viraj. all of you have given the correct answers. I'm glad to see everyone is giving the correct answers. Satish, Guram, Suraj, Mohammed Abdul Rahim, Viraj, Kumari Jyoti, Shailesh, and Mansha. Thanks a lot. So 2750 divided by 30,500 into 100. This comes out to be 9.01%. So the gross NPA percentage at a combined level becomes 9.01 percentage. So this is the dilution. If you understand from the strong bank's perspective, this is a dilution that has happened in their NPA percentage, right? Because they have acquired a weak bank which is having a higher NPA. So their overall NPA has gone up. So that was it from this question, students. Very, very important question and very, very long question also. But this question gives a lot of clarity on how the bank related ratios or mergers and acquisitions work, right? Okay, students. Now let us come to some of the conceptual parts of mergers and acquisitions or theoretical parts, right? So I will be covering certain topics from study material, right? To take all of you through what do they really mean. Okay. So let's first of all start with the rationale for mergers and acquisition. So all of us might be wondering that what is the need or what is the rationale behind mergers and acquisitions happening, right? Or what is the objective? Now, if we see students, there are different purposes or there are different objectives behind mergers and acquisitions. Some of them are synergy. So synergy, we have, as we have discussed or we have seen in lot of questions, what is the meaning of actually synergy? So synergy is the individual values of two companies. If we combine them and operate with a new company, they are lesser than the new company's earnings capability, or let's say the value, right? So the combined value of A and B, which is the new entity, will be higher than the simple addition of value of A and value of B. Okay, this is called a synergy because this is the new company and this is the old companies. So old companies' values, if we add it up, will be lesser than the overall value of the new company. The reason being, so if you see students, let's say A or B getting merged into A. Okay. Now B has lot of overheads, For example, the admin cost is very high. Now what A is saying that I will take over the business of B. However, I will not add anything in the administrative layer because I already have my administrative overheads. So I will manage within that. So that will bring me 5% savings in the profits or in the cash flows, which is reflective in this higher valuation. Okay. Similarly, if you think about that a company is purchasing a raw material at a 10% discount because it is purchasing in bulk. Similarly, B company was also purchasing that raw material, but it was only taking a 5% discount because the volumes were lesser for B company. Now, what will happen? B company, once it is merged with A company, so A company will tell the same supplier, or let's say the regular suppliers, that now see, my volume has even increased. You will have to give me even 10% on this purchases also. So another 5% I will be able to save, which B company on a standalone basis was not able to save because of my negotiation power, right? Because of the scale at which I am operating, I will also include the B company in that. Okay. So these all are factors that leads to the synergy gain. So it's the reduction of fixed overheads, right? Reduction of the administrative overheads. Then any benefits in the RMPM cost, raw material or packing material cost, right? And any, let's say, technological advancements that I'm operating with, that means the A company is operating with, the same technological advancements is actually implemented with the B company, right? Then also it will lead to the synergy benefits. Oh, Venkat is asking if the share value is going down, if the per share values we go down, we can see dilution means, okay, in a simple parlance, dilution means the deterioration. Okay, when the ratio gets further degraded, it is called as dilution. Now, some of the ratios gets deteriorated once they increase. For example, NPA. NPA, if it increases, it is disadvantageous to the bank, right? Hence, we use dilution. Similarly, if EPS goes down, it is a deterioration of EPS, and hence it is a dilution of EPS. Okay. Free float, Guram, is basically the market capitalization which is not held by the promoters. So if you see, all the companies, all the listed companies or all the regular companies have a equity contribution from promoters. That is, let's say 40%, 50% or 60% of the equity is held by the promoters. So whatever is the balance left beyond what promoters are holding, that is called as free float. Yes, Mansha, that is part of the expansion corporate strategy. So synergy is clear, students. Let us move to the second objective or rationale for mergers and acquisition. This is called as diversification. Okay. Diversification, students, in our portfolio chapter, we have discussed about the diversification of the unsystematic risk. How? By creating a portfolio, right? So here also the objective is to reduce the unsystematic risk. Systematic risk we cannot reduce because systematic risk is the risk of the system, which is the macroeconomic factors. Only the unsystematic risk can be reduced. For example, A and B. A is a company with FMCG and B is a company in real estate, right? It's a diversification, right? FMCG is getting merged with the real estate, or real estate is getting merged with the FMCG. So it's a diversification, right? So this will reduce the overall group level. Okay, students. So diversification means that the objective of the merger or acquisition is to create, or let's say is to merge in two different industries so that the diversification in the area of their business happens and hence the unsystematic risk is reduced. Third rationale is actually taxation, which is very, very important rationale. So what happens, students? There is a weak company and there is a strong company. So weak company has accumulated losses. With such accumulated losses, the weak company also has an advantage from the income tax perspective that these are unadjusted losses brought forward, which can be adjusted against the future income to avoid any tax payment, right? So what will happen now? Strong company will look for such weak companies where the accumulated losses are high and they are available for the set off against the post profits. So then strong company will go and tell weak company to get itself merged with the strong company. Okay, sorry. So strong company will ask weak company to get merged in itself so that strong company will be able to utilize the set off of these loss forward brought, loss forward losses brought forward with the future profit that strong company will be earning. To be set off against future profits. Okay. So this is how it will happen. Taxation objective is clear, students? Yes, Mansha, that is correct. That is what we have studied in the portfolio as well. Then let's come to the growth. Now, students, what happens if you see the companies are expected to grow? Again, let me take an example of A Limited, which is a company in a particular industry, right? A Limited is there and 1,000 crore is moving to 1,100 crore. So these are the sales that you're talking about year one and year two. So from year one to year two, the sales has moved up by 10%. The sales has moved up by 10%. So this is a organic growth, right? Organic growth means on the same level of business, how much you are able to grow. Now there is another company called B Limited, which is having a revenue of 600 crores that it is generating, right? Now, if A Limited wants to secure a very good amount of growth, then what A Limited will do is A Limited, let's say, asks B Limited to merge in itself or acquire B Limited. Now, A Limited growth, how it will look like? 1,000 crore for year one, it will directly move to 1,700 crore for year two once it acquires or once it merges, right? So in this 100 crore is coming because of the organic growth and 600 crore is coming because of the inorganic growth. Inorganic growth means because of the acquisition, which was not there in the base year, right? So year one is the base year, correct? So if you see to the investors, what A Limited can show is that, see, I have achieved a 70% growth, 60% through organic means, sorry, inorganic means, and 10% through organic means, correct? So to grow fast, or let's say to secure higher level of growths, is also one of the rationale to go into the mergers and acquisition. Then I think that was the fourth part. Yeah, let's come to the fifth part. Consolidation of sorry, production capacities and increasing market power. Now, again, let's assume there are two companies, A Limited and B Limited. So, A Limited is having a market share of 60% and B Limited is having a market share of 10%. Okay. So, they have a market share of 60% and 10%. Now, what happens? Both A Limited and B Limited gets merged. The overall market share gets created as 70%. Okay. Balance 30% market share is held by, let's say, 1,000 different players. So the biggest individual market shares were with A Limited and B Limited only, which is 60 and 10. Rest 1,000 different players holds the 30%. So do you think the market consolidation is happening here by merging A Limited and B Limited? Yes, because now they will become the strongest competitor by having 70% of the market share compared to the 1,000 people who have only in totality 30% market share. Okay, students, clear? So these are the broad rationales for the mergers and acquisitions. Now let us also understand the second topic of types, or let's say forms of merger and acquisition. So first one is horizontal merger. So let's say there is one industry. What do we mean by industry, students? Industry is actually the collection of companies who are having a common output, or they are satisfying the need of common consumers with the common need. Okay. So let's say one industry is banking industry, right? Because entire banking needs are satisfied in that industry. So industry is the collection of companies having common set of consumers with a common need. So they will have a similar need, right? For example, automobile industry, the need is to get a four-wheeler or two-wheeler, right? That is the collection of all those companies who are giving the product in that manner is called as industry. Now there are two companies belonging to the same industry. If they merge with each other, that is called as horizontal merger. Because within the same industries, these were operating as two different players. Now they have merged. These are called as horizontal merger. Vertical merger. There is a company called again A Limited. It is supplying its products to a customer and it is purchasing the products from, let's say, a vendor, right? This is B Limited and this is C Limited, let's say. Okay. So this is the value chain, right? Vendor is supplying to A Limited is supplying to the customer. So if A Limited gets merged with B Limited, right? This is called as backward integration. I mean, where B Limited is absorbed by A Limited, and now A Limited is saying that even the part what vendor was doing, now I will do that and I will reap such benefits. So that is where A Limited will be called to say as having a backward integration with B Limited. Similarly, if C Limited gets merged with A Limited, this is called as forward integration. And both these integrations are called as vertical merger. So in a way, once the buyer seller relationship is converted into merger and acquisition, it is called as a vertical merger because now the merger is happening between the customer and the vendor. Okay. Whether it is a backward integration or forward integration will really depend whether the integration is happening with a vendor or with a customer. Yes, Mancha, that is correct. Then, third part, conglomerate merger. So, conglomerate merger is actually entering into a very diverse line of the business through mergers and acquisition. Okay, it is entering to a very diversified line. Now, sometimes what happens that some of the business houses doesn't want to grow in their own line of business. They want to acquire other lines of businesses too, so that they want to grow over in those areas as well. Okay. So it is not a horizontal merger where both the companies belongs to the same industry. It is not even a vertical merger where it is a customer or supplier relationship that is getting converted into a merger and acquisition. It is totally different where the rationale for merger and acquisition is diversification. Okay. We have understood about the rationale, right? So the rationale here is the diversification. Rationale here is the diversification and A Limited and B Limited are totally unrelated companies. Okay. And hence they get merged. Then comes co-generic merger. This is very important to understand. So first of all, students, this is neither the horizontal merger nor the vertical merger and not even the conglomerate merger. So co-generic merger is basically, let's talk about two companies who are in the same industry or some factors are common. Example, let's say technique or technology, right? Or so technology is one example. Second example is, let's say, their distribution channel. Distribution channel. Or let's say product line. We are not saying they have the exact same products. We are saying that the product line is similar. If these two companies gets merged, then it is called as co-generic merger. Let me take an example. Let's say A Limited and again B Limited. When can we say that there is a co-generic merger? Let's say A Limited is an NBFC, non-banking financial corporation. And the purpose of A Limited, which is an NBFC, is to give auto loans, automobile loans, correct? So this is giving finances for the procurement of the four-wheelers, two-wheelers, like that. Now, B Limited is also an NBFC, right? But here they are into the credit cards or let's say personal financing. They are not into auto loans because NBFC is created for a specific purpose, right? So here the purpose is the credit card or personal financing. Now, do you think that the product line is similar? Yes. Okay, let's put it like this. First of all, they have different consumers, right? Why different consumers? Because in auto loans, you will have the consumers who wants to purchase a automobile. In personal financing, you will have consumers who will have to borrow for their personal needs. Okay. So different consumer sets with a different consumer need, that is okay. Second, industry is about giving loan. So industry is common, right? Which is an NBFC. Then third is the channel through which they access the customer. This is also common, right? Because they will be accessing the customers through some agents who will help them with giving the auto loans or personal financing, right? So it is also common. And fourth one is their product line. Correct? Product line is similar, only the end use of that loan is different. Correct? So this merger will be called as a co-generic merger, students. So the generic is same. Both of them belong to the same or both of them have the same generics. And hence, once they get merged, they are called as co-generic mergers. Yes, Mancha, you are right. Okay, then, so horizontal, vertical, conglomerate, co-generic. Then fifth one is the reverse merger. We will cover that reverse merger in a detailed manner. Okay, so as of now, I'm skipping this. skipping now to cover later. Then the sixth part which is left is the acquisition, which I think we have already discussed, right? Acquisition is where you acquire the company on a going concern basis. So what you do, either you purchase the majority stake or you influence, or let's say you control the board of directors, right? Let's say through some kind of an agreement or anything that is called as a acquisition. Okay. Now let's come to the next topic of reverse merger. So with this topic is over now, right? The second topic that we have picked, which is the types and forms of merger, is over. Now let us take the reverse merger separately, because reverse merger has bigger points to understand. So reverse merger, when we talk about two companies. One is the large company and second one is the small company. Large company generally takes over the small companies that we know, and small company merges into the large company. So this is a general phenomena. So general trend is that large company acquires or small company gets merged, right? In reverse merger, reverse happens. So small company, which is a private company, takes over a public company. This is a large company. Although this is a large company, but this has, let's say, some accumulated losses, right? No operating business. Okay. So private company acquires or asks public company to merge into private company. Once it is done, then the shareholders of private company will have a majority stake in the public company, and hence this private company will be able to go public, right? Because already that public company is a listed company, right? So as a result, private company would go as public. Clear? Product line is same, Mancha, in the previous part. Okay. So reverse merger actually is when a small company acquires a bigger company, or when a bigger company gets merged into a small company. Ultimate outcome of that is that this is more relevant if, let's say, a private company wants to go public at a very, you know, uh, at a very easy, in a very easy manner, without getting into the specifics of, let's say, IPO, prospectus, and all those things. So what private company can do, can identify a public company, which is already a listed company, which is not operating as of now and has accumulated losses. It can then ask public company to get merged into the private company, and hence the shareholders of private company become the shareholders of the public company, and automatically it gets listed because the merger happens of these two companies, right? So this is what the reverse merger is. In detail, students, I would request all of you to please go through the text that is given in the study material. Then let's go to the divestiture. There was one question also asked in this. So divestiture is basically selling assets or group of assets or business unit. Okay. So that we can pay attention to the core business. Okay. Now, the first part here is the sell off or partial sell off. Within divestiture, this is the first part. So in sell off, what happens? There is a slump sale of business that happens. Okay. Once it is done, it is called as sell off. Simple. I had two businesses. One business I had just sold it out on a slump sale basis. That is called as sell off. Spin off. Second is spin off. Now, in case of spin off, there are existing shareholders. Okay, let's take an example of A Limited. A Limited having two businesses, business one and business two. So the business two is transferred to B Limited, a new company incorporated, and business one is retained by A Limited. So the shareholders of A Limited gets holding in this new company called B Limited. So you remember, students, we did one question, Fortune Pharma and Fortune India. Fortune India and Fortune Pharma. That situation is called as spin-off. Okay? That situation is called as spin-off. Exactly the same situation is spin-off. No, Guram. Guram, the objective behind reverse merger is that only that the small company wants to go public and hence they take this route. Okay? If the objective is not to go there, then they can avoid the reverse merger. Third one is split up. Third divestiture is split up. Now in split up, what happens? Let's say A company is there. It has multiple business lines. So A gets dissolved and transfers these different business to different companies. Okay. Let's say B, C, D, and E get the different companies. The A becomes dissolved. So split up means we have split up the business of one company into many companies. Equity carve outs. Is actually spin-offs plus issue of new equity shares also in the market. So if we do this, then this is called as equity carve-outs. One, you are spinning off the business, let's say Fortune Pharma and Fortune India. Fortune India spin off the pharma business to Fortune Pharma. Now this Fortune Pharma also issues new shares in the market. That is called as equity carved out, equity carve out. Fifth is actually the demerger or division of family managed business. So typically in any country, the family managed businesses, the business houses which are managed by some families, if let's say they want to divide, right? If there is a division in that, so this part takes care of that divestiture, right? Which is it will get distributed. The companies will get distributed or divided as a going concern basis into the different family groups. Okay. Yes, Mansha. So students, let's break for 10 minutes. After that, we will cover up balance two topics left in mergers and acquisitions, then start with the startup finance. So we'll again reconvene at 8:30, 8:45 students. Okay. So students, welcome back. We have covered the topic of divestiture. Now there is a concept called financial restructuring. For financial restructuring students, what happens? There is, let's say, a sick company. Okay. Sick company means that it is going through a very tough phase on the business side, on the financial side, right? So in its financials, there are losses. Current year also and accumulated also, everywhere there are losses, right? And even accumulated losses are greater than the share capital. This is also called as negative net worth, right? And there is no future planned also for these type of companies because there is no visibility by when they will be able to revive themselves. Okay, understood? I think these type of companies are called as sick companies, right? So to revive such companies, there are certain plans of actions that are taken up. What are they? Plan to revive such companies. So the first will be equity shareholders. They have, let's say, 10 rupees paid up capital. So it will get converted into 5 rupees paid up capital. Okay. So for equity shares, the value will go down by 5 rupees. Similarly, there is a loan or borrowing in the financials of the company that earlier was 10%. Now we have renegotiated with the lender and we have said that now we will pay you only 9%. So 1% we want benefit because we are a sick company. We are not able to revive. Okay. Then third, will be, let's say if we have again loans and there is a risk on the principal amount also, then we will convert them into the convertible loans or debentures, right? So that there is no cash outflow that is happening. They will get converted into equity. Yes, Mancha, that is true. So that is called as, I mean, all these measures are called as the, I mean, these are measures are taken to revive the sick company. And hence these are called as the financial restructuring. Another point in terms of working capital, vendors, you can ask them to forego 25% of the amount. Forego 25% of the amount so that we are only supposed to pay balance 75% as a part of this restructuring. Okay. Okay, students. So this will help them to kind of reduce down their exposures and then set off their losses with such gains that are happening. Okay, student, this is called as financial restructuring. Then we also need to know what is ownership restructuring. So in case of an ownership restructuring, students, there are different ways. Okay, let me start like this. One is going private. Going private means there is a public company already listed on a stock exchange and it wants to convert itself from a listed company to a private company. How can it do that? So there is a public company, right? That public company will do a buyback of own shares from market. The moment it happens, it will form into a private company because from the market it has taken back all the shares that were operating or let's say that were floating, right? So that public company has gone to the private company. That is called as the ownership restructuring. This is the first part of ownership restructuring. The second part of ownership restructuring can be management buyout. This is a very important term, students. Buyout. This is also called as MBO, management buyout. In case of a management buyout, the management of the company, let's say the board of directors, the CEO, MD, what they will do, they will buy the company itself. They will become the shareholders of the company. Management itself of the company will purchase the company. This is called as management buyout. Third part is called as leveraged buyout. This is called as LBO, leveraged buyout. In this case, sorry. In this case, the purchase consideration that we need to discharge, okay, is discharged by taking a loan. So what happens? Borrowings taken. After that borrowings is taken, then PC is discharged. So purchase consideration is paid using the borrowed amount. Okay. So in a way, what you are doing, you're taking a loan and then you are purchasing a company. That is called as a leveraged buyout. Why it is done so? Because borrowing involves a lower cost of capital and you will get the tax benefits as well in that case, right? And the last part is the equity buyback. I think which we all of us know what is an equity buyback. We are asking the shareholders to sell back our equity to us and we will pay you the current market price or any other price that is agreed using the same. Okay. Now, students, This is the last topic from mergers and acquisition. Then we will move to startup finance. Okay. SPAC. So please understand the structure of these companies. These are special purpose companies. Yes, Gurram, you're right. Gurram is saying management buyout means buying the ownership from promoter to management. Yes, that is true, Gurram. Okay. Now, SPAC, special purpose acquisition companies. In these companies, first of all, there is a IPO, okay, which is an initial public offer. There is an initial public offer. Using that IPO, funds are raised. Raise funds from public at large. Okay. Raise funds from public at large. Once the funds are raised, let's say this is the SPAC company. I'm drawing it here. Then we will be able to demonstrate. SPAC will launch a IPO. And similarly, SPAC will also form a trust. Okay. This money that is received by SPAC will be kept in a trust or in a escrow account. Okay. In a escrow account. Why it is done so? Because this special purpose acquisition company is entrusted with a task which will take 2 to 3 years. And after that, we need to use the funds. Till then, the amounts will be kept in a trust or in a escrow account. That is point number 1. Now, what is that task? As I told you that there is a task that is going to take 2 to 3 years. What is that task in which the funds are going to be utilized? The task is to acquire a target company, to acquire a suitable target company. Once the SPAC has identified a suitable target company, then the amount will be withdrawn from the escrow account or from the trust and invested in such company. Okay, so let's say the steps are: before finalizing a deal, approval from majority shareholders. Till the time the deal is finalized, money is kept solely in the trust or escrow account. Okay. Why it is done so? So that the amount is secured, right? Then this SPAC company also needs to have a proper due diligence, right? So that in due diligence itself, it comes out if there are some red remarks on the target company which they are planning to acquire. Understood? So special purpose acquisition companies are incorporated with the objective to identify and invest in a suitable target company. Now that entire activity will take, let's say, 2 to 3 years. They will launch an IPO, raise the funds today and keep it in the escrow or trust. The moment they finalize a deal, they will withdraw the amount and they will invest it. Now, before finalizing a deal, they need to take approval from the majority shareholders also, so that there is a proper governance that is ensured. Okay. Now, SPAC are also called as blank check companies. Blank. Reason being, while giving the funds to this SPAC, we don't know what is the end objective or where are these going to be invested in future, right? So we are giving these amounts on a blank check basis. Okay, we are giving you now in whosoever name you have to spend, you spend that. So there is no name on the check. It's something like that. Okay. Done, students. Now let us move to the startup finance. So first of all, students, what do we mean by a startup? So let me tell you, Government of India has given a definition of startup, because whosoever falls under such definition will be entitled for some of the benefits. Okay, now what is the definition or what are the conditions to be satisfied by someone to be qualified as a startup and hence to take benefit of such initiatives? Number one, that entity should be in the form of a private limited company or registered partnership firm. Sorry. Registered partnership firm or limited liability partnership. They can be in the form of private limited company, registered partnership firm, or limited liability partnership, LLP. Only these are the forms that are allowed. Why we are not allowing public limited company? Because if it is already a listed company, then there is no need of a startup because it has already raised the funds. Initial stage, it has to be a private company. Then later on, it can become a public company whenever it wants to become. This is the first precondition, students. Second is that there has to be a timeline also. So first 10 years of incorporation should not get lapse. So after 10th year of incorporation, it will automatically come out of the definition of startup. So we're saying that first 10 years, we can treat you as a startup if you are a private limited company, registered partnership firm, or limited liability partnership. Third condition, in these years of operation, in the first 10 years, the revenue should be up to INR 100 crores. If this is the revenue, let's say turnover should be up to 100 crores. If that is the case, Then let's say if a company started and in the first year of operation itself, it achieved 200 crore of revenue, it will not be a startup. Till ninth year, the company is having 50 crore annual turnover, then it can qualify till ninth year as the startup. Now suddenly in 10th year, the turnover increases from 50 crore to 150 crore. So in the 10th year, it will not remain a startup. Okay. Fourth condition, it should not be formed by split or reconstruction of existing business. So there should not be any splitting or reconstruction of the existing business. How it happens? We just now read in mergers and acquisitions. In divestiture, if there is a spin-off, if there is a split up, if there's a demerger, so the existing business is formed into a new company, which is let's say up to 10 years and revenue is also up to 100 crore and it is formed in the form of private limited company. So do you call it really a startup? No, right? Because you have not started anything new. You have just split it off what you have existing, right? Then comes fifth part, which is innovation, development, deploy, or commercialization. So till now, we have actually gone through some of the regulatory things. Now let us go to the business objective. The fifth part is actually to do with the business objective. So the business objective of that startup should be to innovate, to develop, or to deploy, or to commercialize new product, process, or service of any new product, process, or service. Correct? So anything new has to come into existence. New what? New product can come, which has a different utility altogether with the existing products in the market. New process has to come, right? Or new service has to come. New product, process, or service, which is not existing in the market, which has to be driven by technology or intellectual property. So technology or intellectual property. So students, Mayor opening up a new business which satisfies all the conditions from first to four. But if the fifth condition is not there, if there is new technology, if there is no proper technology is being used, which is helping in to innovate, develop, deploy, or commercialize the new product or process or service, then it's not a startup. For startup to happen, it should be a new product, first of all, new process or new service, and there has to be an element of technology or intellectual property in that. There has to be extensive use of such technology or intellectual property. Then only we can say that this is a startup. So the student, the definition of startup is clear now. Okay, Viraj, Shailesh, Mansha, yes. Perfect. Now let us move to the next part. Now, since these are the startups, right? For the startups, the financing becomes a very important consideration. So the topic is innovative ways to finance a startup. Are there some innovative ways to finance a startup? Yes. First one, personal financing. By personal financing, we mean that the founder of the startup, now who is the founder? The person or group of people who come up with the idea of starting a startup, right? Who have the technology, who have invented the technology, or who have invented that intellectual property so as to develop, innovate, deploy, or commercialize a new product, process, or service, right? Those people who take that initiative are called as founders, right? Who start the startup. Now, if the founder by themselves are having some of their savings that they want to bring in to start a startup, that is called as a personal financing, right? This is very, very common way to finance a startup. Second is personal credit line, correct? By personal credit line, we mean that if banks or NBFCs have given you some personal related credit enhancements, or let's say credit lines, which we can use for the personal purposes, then even founders, what they do is they use those personal credit lines for the purposes of the business, right? Now, whether it is right or wrong, let's not go into that, but it's a means of financing their startups using the personal credit line. Third, friends and family. So this is an informal borrowing, students. This is an informal borrowing wherein they will reach out to their relatives, friends, families to get the initial amount required to start the startup, right? So in this manner, they will be able to arrange some finance informally with the help of friends and family. Fourth, peer-to-peer lending. Now assume, students, there are 100 founders who are part of one group. Okay, they have formed one group and they are part of that group. Now they all are peers in that group because they are all having a startup which is equally, defining or satisfying all the definitions that we have stated above. Now, some of them have excess money and some of them are in the need of money. So what they will do, they will make some rules of that group wherein the people who need money or the peers who need money will put a request in the group. The peers who have excess money will extend the availability of funds to give the loan to them. And hence, the money utilization, where it is excess and where it is needed, will get sorted. This is called as peer-to-peer lending. And students, peer-to-peer lending is very much common since the very beginning of years in India, right? For example, we are not talking about today, but we are talking about, let's say, 10, 20 years back also, even before the startups came as a concept. Reason being, at that point of time, the peer-to-peer lending was happening in an informal way. right? You would have understood something about the kitty, right? Let's say everyone will put for 12 months some amount, and in 1 month they can withdraw the amount from that group, right? So this is the same concept of peer-to-peer lending. In this case, the only caveat is that the peers are all founders. Now let's go to crowdfunding. Now this is an important concept. Crowdfunding. Students, crowdfunding is a way by which there is a platform that is set up. Now on that platform, small individuals register them as investors, and they will contribute very small amounts, let's say 100, 200, 1000, 2000, like that. And in that platform, all the people who will need funds will also submit their cases. For example, there is a startup A. They will submit their value proposition on the portal. Now, the small investors will go and see that what is really in that company if we want to invest in that. Now, crowdfunding means that thousands, 10,000s, lakhs of small investors will invest small amounts. So this is called as crowd, right? Crowd means very high number of investors who are investing smaller amounts into some purpose or objective of that startup. Okay. So the smaller amount is sourced by high number of vendors, a high number of investors. That is called as crowdfunding. Now, crowdfunding, students, is also called a startup because this idea itself of arranging the funds was also a new idea through crowdfunding, right? So once this concept came earlier, this also started as a startup. Okay. Microloans. So you would have heard, students, while understanding from the bank's perspective, that bank have a separate division of microloans, wherein they give loans at a cheaper rate to the new businesses who are starting at a very slow scale, or let's say at a early scale, right? So these microloans are available by the banks. They will give it formally with a lower rate of interest, assuming that they are starting the business. Then comes vendor financing. What is exactly meant by vendor financing, students? Vendor financing is a way by which we will ask the vendors to increase the credit period. Let's say regular credit period is 30 days, and we ask them to increase by 15 days to make it to 45 days. This will help us to finance ourselves at least for 15 days because we are deferring our payment to the vendors. But a caution should be made that we should not end up increasing the prices, correct? Because if we ask for higher credit, vendors will ask for a higher price. Purchase order financing. Now, purchase order financing, students, what happens? Let's say the startup has got a purchase order. Okay. It will approach to the institutions, to the financial institutions, that since it has got an order, a confirmed order, which it has to service. But before servicing, it also doesn't have the required capital, right? it doesn't have the required capital. So to arrange for that capital, it will ask that, see, here is my purchase order. I want 1 lakh rupees to service this purchase order. You lend me, I will repay you back with the interest. So on a PO to PO basis, the financing happens, not on a general basis. Okay. Then next one, factoring account receivables. Vignesh, I will not have that information, Vignesh. I request you to please keep in touch with the examination department when will be examinations or whether it will be postponed or not. Okay. I am not sure about this. So please keep in touch with the examination department. Okay. Now factoring account receivable, students. Now factoring means that I am getting my receivables discounted on today's date. Okay. Discounting receivables on today's date, realizing the amount today, right? Let's say my receivable said that after 30 days, I will be getting X amount. Now I say to the fact, I mean, to the person who is doing this factoring, that you pay me today and you pay me something less than X on account of the interest cost that I'm okay to bear. So this is called as factoring account receivables. Okay, I think all of you would have understood or earlier studied it happens on a recourse basis or non-recourse basis, right? If it happens through recourse basis, that means the uh, the person who has done the factoring will have a recourse back to the originator. Originator here, I mean the startup, right? Where the origination happened to claim the money back. And non-recourse means that you cannot claim the money back. Once you have transferred, it is your risk. Okay, students. So these are the innovative ways to finance a startup. Yes, Shruti, that is correct. Now, let's go to the. So these were the innovative ways to finance. Okay. Now let's come to the concept of unicorn. Okay. Can anyone attempt this? What is the meaning of unicorn? In the startup world, what do we mean by unicorn? Okay, students, come on, answer me. What do we exactly mean by unicorn, students? Or what are the ways, or let's say, what are the measuring criteria defined for a unicorn? Tell me, students. Whatever comes to your mind, please share your thoughts. Yes, very good. Sumit, Shruti, please recheck. It's not that value, it's higher. Sumit and Mancha, you are right. So, unicorn is a startup where the valuation has reached USD $1, USD 1 billion. startups valuation, right? Now, how is this valued? Simple. If let's say today some investor is purchasing a 20% equity at $300 million, right? So it means that the total value is how much? 1500. That is $1.5 billion, right? Correct? Is it true? So since this 300 million got invested at 20% rate, we call it as unicorn. Yes, it is used, Viraj. You're right, it is used. Okay. Now in the study material, if you see, there are a lot of startups that have been mentioned as unicorns. Okay, so you can go through that list. Now let's come to the next topic, which is the modes of financing. For startups. What are they? See, one is bootstrapping. One angel investor and venture capital. Yes. So we will cover these three. Perfect. So now modes of financing of startups are different, right? One is bootstrapping. I think this term, see Ashish sir, in our previous session, I think he has also touched upon to this, right? Now, what is bootstrapping? Bootstrapping is actually making use of the available resources, right, to finance yourself, right? Bootstrap means that you are using your available resources. You're not going, uh, somewhere extra mile to procure that finance. For example, trade credit. As we discussed, students, trade credit is what? Trade credit is actually a method wherein we will ask our vendors to give more credit. Let's say the original credit period is 30 days. We are asking for 45 days. So that means we are asking our vendors to increase our cycle. That is called as trade credit. Second was factoring, students. Factoring our accounts receivable. Correct? In which we discussed that whatever our accounts receivable, we will sell it to a agency, to a financial institution. It will pay us the amount as on today before the due date, and it will deduct certain amount on account of the commission or banking charges or interest charges, and ultimately it will be on a recourse or non-recourse basis, right? If it is on recourse basis, we will so that agency will move back to us in case of a default. If it is on a non-recourse basis, the risk of that non-payment rests with that company itself. This is called as factoring. Third was leasing. So this is something new, students. So I think trade credit and factoring we have already studied in the innovative ways also. So please do remember, if the question is what are the modes of financing for startup, then this will come bootstrapping, and under bootstrapping, trade credit, factoring, and leasing. But what are the innovative ways that we have already studied? Okay. Now leasing is basically, let's say you want to purchase a capital item. Rather than purchasing the capital item, what you do is, and now as an alternative, because for purchasing you need capital at day zero, you can go for a lease, wherein you will keep on paying the lease rentals month on month, whenever you use. So you can avoid at day zero the big investment in the capital items that are required. Now, leasing can happen for plant and machineries also. It can happen for furniture fixtures, even for laptops, right? You can even get laptops on lease so that your initial investment is not put in these assets, right? And hence you are not, you know, short of the funds that you know initially. So again, leasing is also a way which is available internally itself. That is why it is called as bootstrapping. Even trade credit for that matter, something that is available. Factoring also, right? So these are the use of the available resources with the company already that can happen. That is why it is called as bootstrapping. Now, next one is angel investors. Who are these angel investors? Angel investors are just like angels. Why? Because they come, they are certain high net worth individuals, okay, who are in the network of that founder. Let's say there is a founder who has started a startup and is in need of funds. They have a big network. In that network, there is a person who knows the founder. Now that person is having a good amount of funds and he or she is also willing to invest. Now, while he or she is willing to invest and give that amount, right, as a single-handedly, you know, amount to them, so that investor will be regarded as an angel investor, students, right? Because that investor is acting like an angel, right? As a person who is saving the business from the financial needs, right? So they will invest in small startups or entrepreneurs who have good ideas, right? So they will give that investments and they will use their own money, students. Angel investors will use their own money. Okay. Third part is actually venture capital. Now, students, this is a very, very important topic. I request all of you to please hear me out. Yes. So venture capital is actually structured in the following manner. So first of all, students, there is a special purpose vehicle. Friends, just allow me a 30 seconds. Yes. So what I was saying is the structure of venture capital has to be understood first, right? So that we know what is venture capital. Now, for understanding that comes into existence, okay? There is a SPV that comes into existence. There is a special purpose vehicle. And who brings into existence these company? There is a private equity firm. Private equity firm. Now, what is the role of this private equity, students? So first of all, please understand there are two terms, right? Private equity and public equity. Public equity comes through an IPO, right? Initial public offer to the public at large. Public will invest in the company. That is called as a public equity. Private equity comes from the investors privately, right? It has no public significance. It will come to the company in a private manner. Now, yes, this is on the venture capital, right? So private equity firm, there is a SPV. They float SPV, right? I mean, this firm, private equity firm means there is a entity which has a role to play for private equity. They keep on looking for the avenues wherein they can invest their private equity, right? Now, this SPV will be in the form of trust or LLP, limited liability partnership. Okay. Now, this private equity will put some funds in SPV, and what will happen? Invest amount, and it will also oversee the governance of this fund, right? Pool of funds, right? So some amount will be contributed by private equity through SPV in a pool of funds, and this pool of funds will be managed by SPV. Now there are other people also who will be invited to invest, or let's say put some amount in such pool of funds, which are banks, financial institutions, pension funds. So these are those who have ample of money, right? And then also high net worth individuals, right? So these people will also put amounts in this pool of funds. Whatever they want to put or how much they want to put, that they will decide, right? So till now, students, what we have understood, there is a private equity firm which will float a SPV in the form of a trust or LLP. They will invest, let's say, 5% of the total pool of funds. Balance 95% will come from other people who are banks, financial institution, pension funds, and HNIs. Clear, students, till now? Okay, clear? Then these people who have invested are called as limited partners, right? Because they have a limited liability, students. Like in share capital, whatever amount is invested through paid up share capital, that is called as a limited amount, right? Similarly, it is called as a limited. Since they have a limited liability, they are called as limited partners, and their role to play in the pool of funds being utilized is also limited. There are another people who are called as general partners, right? They are actually appointed by this private equity firm, or they belong to this private equity firm, who have also contributed to this SPV in the form of pool of funds, and they are the decision making authority for this fund. They are the decision making authority for this funds. Now, where this pool of funds will invest? This pool of funds will invest in startups. Startup 1, startup 2, startup 3, like that. But first of all, startups have to come and pitch for their idea. And there is a separate manager, administrator slash advisor, whose role is to go through these presentations of individuals and then recommend to general partners, that we can invest in such and such startup so that our investment multiplies. And then once it is done, after decision is taken by general partners, the investment will flow in to the respective startups. So there are three phases, students. One is buy phase, second is grow phase, and third one is sell phase. So buy phase, we invest. Grow phase, we intervene. So there is some sort of intervention from these general partners, because what happens once they decide to invest in a particular startup, they also are willing to give the knowledge to ramp up the business, to scale up the business, right? So one of them will also sit on the board of directors to make these decisions, right? So that they can grow the business. So that is called as intervention. So buy is investing, grow is intervention, then sell is divesting. So here they book profit. So let's say they invested 1,000 rupees. They have grown it to 7 times, let's say in 5 years. So they will reap out 7,000 and ultimately they will earn 6,000 of profit for 5 years by investing here. Because they will invest behind the value of the company, right? Shruti is saying clear. Mansha is saying C capital, Shalesh like short Shark Tank. Okay. Yes. Now there are different stages, right? There is seed money whenever you want to form up your idea. For that seeding of the idea, you need money that is called as seed money. Then startup, first round, second round, third round, fourth round. I mean, as and when you keep on expanding, you will get that various lines of investments, right? Once you are able to prove also, right? Now, students, there are two different types of structures for venture capital. Okay, so one, there is a domestic structure. So in domestic structure, all these people, whether it is a private equity firm, this SPV, these general partners, these people who are the limited partners, the pool of funds, and even the manager are all based out in domestic territory. Okay, clear? Then there is something called as in the offshore structure. There are another two types structure of VC. Will say offshore structure and unified structure. Okay. So the offshore structure, students, is a structure of VC where the SPV is outside India, right? The SPV incorporated is outside India. It's not in India. But the manager, who is the investment manager, who is actually looking out for the different proposals to invest, is based out of India. And ultimately, the investment also happens in India. Clear? Offshore structure is clear. Offshore structure, we mean only the entity, or let's say the SPV, which is created. It's not created in India, it's created outside India. In the unified structure, students. So SPV is outside India. Now this SPV creates the pool of funds, right? Now in this pool of funds, the investment also comes from outside India, and people, or let's say investors who are there in India can also invest into this pool of funds. So investors based out of India also invest, investors outside India also invest in this pool of funds. And then these pool of funds gets invested in India again back. So this is called as the unified structure. Okay. So this pool of funds is held in the form of trust in India, right? Because pool of funds has to be maintained in some legal form, right? I mean, we need to say whether it is a trust or whether in what form it is held, in what legal entity form it is held. It is held in the form of trust, students, which is again incorporated in India. Clear? Then succession planning in business. This is the last topic. Okay. So succession planning in business has been newly added, and we need to understand that what is the context behind the succession planning. Now, if you see, students, any business or any company have very significant or key roles present in them, which have the strategic direction of that company, which have the vision for that company. Without them, the company will not move in a direction, right? So to plan for that successor in those roles is really very important, because if we are not going to do that, then we are posing a big risk on the continuity of the company, right? So in a way, succession planning has become very, very important, right? So that we identify the right talent, we identify those significant positions where that right talent has to be fit in. Now, what are the needs? One, as we said, that risk mitigation. As I said that there is a big amount of risk if the current person who is handling those critical roles has resigned or is moving out. In that case, there is a risk that there is no one else to take over. Okay. Second need is the cause removal. By cause removal, we mean that if the leader, or let's say the person who is holding a significant position, has committed certain deeds which are not legitimate for the business needs, then as per the laws or as per the articles or MOAs, the person has to leave. In such a case, again, and that is called as cause removal. In such a case, again, there will be a big hole that will be left, without which the company will not be able to survive. Hence, succession planning is also important in such cases. Then third is talent pipeline. So in talent pipeline, what we essentially mean is that if you give your talent a clear visibility to the career path that okay, after 5 to 7 years, you can become a leader, right? Or a person which is holding a key position that will give that talent and that will retain that talent into the organization so that the succession planning becomes very much important so as to keep that talent. Then conflict resolution mechanism. By doing succession planning, you're actually resolving your conflicts, right? Then similarly, aligning. What happens in India, there are big business families, right? So in a family-owned succession planning, you are aligning the new person, or let's say the vision of that family-owned business with a new successor. Okay. Now, how to do the business succession, right? Or let's say what is the strategy behind the business succession? Right? What are the steps that you need to follow? Or let's say what is the strategy behind the business succession? So first of all, or let's say step one that we have any which ways discussed is to evaluate key leadership positions. Evaluate key leadership positions. Now, these are those leadership positions which have the strategic vision for the company, which directs the strategy for a company. Now, these key leadership positions are what? So they can be, let's say, the MD, CEO, or the one level down below them, or any other person that is identified by the business to be a key leadership position. Okay. Then step two will be to map the competencies required for the above leadership position. So what are the qualities needed or what are the skill set needed, right? So the second step is to map competencies of current workforce. Sorry, for above positions, map competencies of above position. Now, once you have identified, you need to know that which type of qualified person, what sort of experience, how much experience, what all areas experience will make that person competent for the above position. So you have identified position and then you have analyzed the competencies behind it. Step three, then what we will do, we will look in the internal current workforce. What are they currently competent with, right? So identify competencies of current workforce, right? Now you need to know that the current pool of people that you are holding, what competencies they have and what skill sets are they driving. Can they become a leader or can they become a prospective candidate to take up such leadership position that you have identified in step one? Those all mapping or those all discussion analysis that has to happen. And last, which is a very important thing, which is a bridge leader. Bridge leader, as all of you might be aware of bridge financing, right? Bridge financing is ultimately whatever you want to finance, that will happen, let's say 1 year from now. And today you need funds so that for 1 year you take a bridge finance. So it's a temporary finance, right? So bridge leader similarly is a temporary hold leader who will be able to execute, who will be able to deliver. But you are ultimately holding that for your next person who you have identified in your family to take on the succession. Okay. Or someone else who you want to take up for the succession purposes. Right. Now, lastly, there are certain challenges for succession planning. Now, what are the challenges? So first one, since we are studying this topic in the context of startup, so startup has founder. So founder mindset is totally different from the corporate mindset. The person who is a corporate manager will have very low risk taking capabilities, will operate within the boundaries of that policies that are there in that corporate. However, in startups, since the structure is evolving, they will have a higher risk taking capabilities. They will have to take the faster decisions, right? So the mindset is different. So really, you cannot replace a corporate manager with a founder, or you cannot replace a founder with a corporate manager, right? So that is the first challenge in the succession planning. Then second is, if startups go on and implement the succession planning, so they will end up consuming their higher bandwidth in the succession planning itself rather than focusing on the key things. So it will become very premature for them. Okay. And last, you cannot plan for a succession of a founder because founder is the face of that particular startup. So you really cannot replace that founder in terms of the succession planning. That is the challenge, right? However, if because of these reasons that we mentioned, risk mitigation, cause removal, if there is a cause removal and founder is required to leave, then in that case, you will have to do a succession planning, right? So with this, students, the topic of startup finance comes to an end. Okay, let me see the queries if something is there. No, I think mostly it is done. So I request now C. Ashish sir to please help us with the concluding remarks.
Thank you,
Thank you.
Devas.
Thank you.
Thanks a lot. And student, with this, we come to the end of our classes for the paper A, Advanced Financial Management, paper number 2, final level for the May 2024 examination. However, as I mentioned in the first class, these class shall be also be referred for the November 2024 examination because there are nothing amendment kinds of a thing. Of course, we shall plan something for November 2024 class for something else, but it is not be maybe not be the live classes. It will be some recording version, then query session spotted by query session. So you can refer the same. There is not a problem. Now, Devas sir, I want to take one or two queries. Student has asked one, I think this is Vignesh, has
Yes.
mentioned about exam stress,
Postpone. Yes.
postponement.
Yes, sir.
Now, Vignesh, please note that. See, beta, stress is to everyone, even at this age. When sometime back I was going for some exam, so even that a same level was stress with me. Stress is not does not mean because when we have to carry out something, we have to do some task. Planning goes in our mind, so that cannot be considered as a stress. Stress may be when we are not prepared. Okay, when once we are prepared, then there will be no stress. So my request to you, please make strong your conceptual knowledge, then you will not face any problem. Of course, please attempt mock test and please do be in touch with us, Board of Studies. We will help you in any manner, whatever you want. And Shruti was asking, sir, it is a theoretical chapter, no numerical of question. Of course, no numerical questions generally are not asked from this, but sometime we cannot exactly say ki paper setter's mind, what is the mind? They can even frame a practical question from a theoretical concern, but that happens very rarely. Okay, so don't worry, be prepared. Whatever manner, you just understand the concept, then even you will understand the numerical question. So there will be not a problem. Now, since it is the end session, Shruti is saying, sir, I thank you for lectures. Okay, very good. Thank you, Shruti. And practical, useful. Salesh is asking. Mansha is asking. Thank you. Now, student, before I conclude this today's session and this final session, one more point I would like to mention. In the chapter of security valuation, the topic left was money market instrument. Since it was a very small topic, So you can do it your own. And in case you have any query, please you contact to us, because once you understand the bond valuation, then you will not face problem. And similarly, there is a topic bond refunding decision. Bond refunding decision we have covered in our first or second class. So you can refer the same methodology there, then you will not face any problem. And in the end, I would like to take the name of some student who have attended our session on a live basis, and they are interacting in the class. Of course, there are many other students whose name we may not taken right now, but we thank you all them. So I am taking some name. This is Mansha, Salesh Mane, Viraj Desai, Guru Ram, Suraj Kulkarni, Mohammad Abdul, Kumar Jyoti, uh, Satish Kumar, Anush Shanbhog, Sumit Jain, Tanisha, Namarta Surve, Devraj. So if any name has been left, please do let me know. So, but these are the students who have keep the communication two-way. If they are not understanding anything, they are sending a query. So this type of interaction makes success of any make any success makes, we can say, it makes the success every each and every class. So we expect also from the student, even a student, I say that if you find any inconsistency or any error in the study material, please do write to us or please contact to us, because it will help to improve the quality of study material, and that will be help to do for next generation students. So with this student, we are coming to end of the session now. When I was planning to have a closer section covering all the aspects of the syllabus, but student, we have arranged a BOS at success program at 11 yeah, now after 1 hour. So there I will cover the overall syllabus. Okay, and I will give you a brief syllabus there. So my request to you, please do attend this syllabus, this session, because we will cover each and every topic. We will try to cover syllabus. What are the syllabus nitty-gritties of the syllabus? We shall cover there. So, okay, students, with this, we come to the end of these classes. And thank you all for patiently listening and remaining attentive in each class. And Devas sir, thanks a lot for taking such all the long classes, and whenever we requested you on a urgent basis, you have always exceeded our, you have accepted our request.
So, sir,
And
thanks a lot, sir, for this opportunity. Thanks a lot for the opportunity, and I would like to thank the you as well as the entire BOS, and as well as to all the students. So to have patiently listening me. Yeah.
thank
Thank
you, sir. Thank you,
thank
Devas sir. We wish you avail your services in future also.
you, sir.
And I think you are the one of the favorite students of the students, favorite sir of the students, because normal students say, sir, Devas sir, Devas sir, Devas sir. So,
Sure.
okay, Devas sir, thank you.
Sure, sir.
Thanks a lot.
Thank you,
Okay,
sir.
student, thank you. Thanks a lot. And have a nice day and best of luck for your examination.
Yes.
Okay.